Okay, on today's show, 3 questions. Number 1, how does one trade in uncertain times? Number 2, is the market being lulled to sleep? And number 3, are you spending too much money? Let's go. Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
Jake.
And I'm Rabih.
What's up, guys? How are you?
Good. How are you?
Doing great. It always feels good doing another 2 cents. I don't know how many weeks in a row we've got, guys, but we have got a streak going. This is
Actually,
awesome.
in May, we'll hit 1 year of doing 2 cents.
Oh, really?
Yes.
Okay.
So
we got
2 months to go.
Okay. That's good to know. I haven't even looked back to check. So we're a year in May. We're going to have to do something special. We're going to have to do like a whole group show or something again.
Yes.
So this is awesome. This started on kind of a whim, just a general random idea. And it's, again, we got our streak going out. We haven't missed a week. So this is fun. Okay. So let's jump in. Rabih, number 1, how does one trade in uncertain times?
Yes. With full disclosure, I'm playing on words here. Because usually when we say uncertain times, we think COVID. We don't know what's going to happen with inflation. But I'm taking the other side of the coin here. I struggled this week trying to find a topic. Actually, there were multiple topics, but I struggled to find a coherent story. And when you can't find a story, you feel uncertain. Like, oh, this happened and that happened. How do they relate to each other? So I'm going to throw the stories at you, and then we'll go on to the trading. The first story that we got is that on Tuesday, Bitcoin reached an all-time high. Again, it's an intraday all-time high.
To the moon.
To the moon, 69.55% up just in the last month. And then it did not close at the all-time high. It crashed 8% right afterwards. But talking about like what happened, what drove it, it's not that now we have spot Bitcoin ETFs, the other 2 cent we talked about, and now there's more accessibility. But there's more of a supply-driven constraint heading up in April. The algorithm that allows you to mine how many Bitcoins you can come up with from extra set output of energy is halving. It's like dropping in by half, which means
hindering supply.
Hindering supply drives up price. And this is what's happening. And the interesting part is the moment it reached an all-time high, it dropped significantly quickly by 8%, is more of a profit-taking behavior where we expect that all other people who bought it at an all-time high in 2021 and were struggling, waiting for it to recover, just got their breathing and they decided to get out of it. So that was the first story. And another uncorrelated story, if you guys remember the New York Community Bank, which its shares fell by around 60% last month due to a provision regarding commercial real estate on its balance sheet. Well, it got funding from a private equity firm for $1 billion. The private equity firm's name is Strategic Capital, and it's headed by the ex-Treasury Secretary, Steve Mnuchin. So Liberty Strategic Capital, specific fund is going to fund in $450 million, whereas other smaller private equity firms are funding in $1 billion. This is a sign that, well, they did some strategic personnel change. They changed the CEO. They tried to filter out culture issues and like agency problem between shareholders and management. And now there is a path forward to take those healthy assets, in a sense, back to a good position for the stock price. What does this mean in a global sense? This means that this is a good sign. If other investors are willing to tap into New York Community Bank again, it means that they do not think the contagion effect in the banking sector, in the financial sector, is too strong, and they are willing to take on the risk and try to capitalize it to higher return. This is just an undervalued security at this point if they can flip this thing over.
Sorry, is part of that, Rabih? I know it's speculation, but do you think part of that is them feeling like there's a backstop being the government, in the sense that they won't allow a contagion effect? Is that part of this, you think?
That might be, because now the banking system is too big to fail, right? But I was like reading about it, it looks like part of the reason why New York Community Bank had struggles wasn't only the fact that, yes, commercial real estate is taking a hit, they need to increase their provisions. They had to increase their provisions in a time where the bank grew over 100% in 1 year, because they acquired portions of the failed banks like Wright Capital and Silicon Valley Bank in 2021. They bought a portion of those banks. They grew up too quickly. their compliance requirements of how much they can hold in risky assets changed. And for them trying to juggle between the new compliance requirements that they had to deal with, on top of a hit to a certain portion of their book related to commercial real estate, showed up in quarter earnings that this bank is heading to default if it continues that way. But this is not, it's not like the banks, the loans that are holding, they are defaulting as we speak. No, it's a matter of trying to get themselves out of this tight squeeze. If they can flip this over, we would expect the bank to stand back on its legs, whether in its current form or if someone else buys it, right? But I don't think the problem isn't with the assets themselves, it's with the management of them. In 2008, it was the assets themselves. People were buying houses they can't afford and they were defaulting on them. Over here, companies are leasing offices, but they are not using them, so the demand slowed down. It's not that they can't afford them to start with. Companies have money to pay the rent.
Got it. Makes sense.
And the last story, which was also unrelated, is that the Federal Reserve, twice a year, the chair of the Federal Reserve, our beloved Jerome Powell, has to testify to Congress. And yesterday and today, he's been testifying. He didn't really say anything new. All the stuff that we've been repeating on the podcast. There is a risk if they drop interest rates too quickly because inflation might creep back, and there's a risk if they do not drop it really quickly because they might force the economy into a recession, and they're trying to balance their actions. And March 20th, we're going to get new summary of economic projections from the Fed, which we can talk about more. So me seeing all this news and looking, it's like, okay, so there aren't really a full economic story that would explain how the market moved. And the market didn't really move. It just fluctuated and kind of stayed flat throughout last week. Here's where I think I would say putting the science and the math aside and focusing on the human plays a big role, because you would expect, like, so what should I be doing? What trade should I be making? I need to go and make money for our clients, right? And sometimes the best option to do is to be patient and disciplined and do nothing. So in a sense, our clients were paying us to do nothing because this is the right time to do nothing. And unlike, because I opened like Apple News and CNBC and, Fox Business and all those places, and you look at them, it's like, top 5 stocks to trade this week. Where are employment numbers gonna be? And here's the trade to capitalize on it. I'm like, given that I don't have a story, a narrative, a way to trade, I shouldn't. But media is still telling me to trade. And I found that very interesting. And I think for once on this podcast, I should tell you that sometimes the right thing to do is not to trade.
Yeah. I mean, I would say that. I personally say that all the time. And I think distinguish between trading and investing. The media is playing the trading game. The media has a different motivation and incentive than you do, which whenever there's a misalignment of incentives that you can highlight, there is danger and usually for the individual at that point. So I'm totally.
They want you to read their articles. They want you to listen to the news show. They want you to read their articles. They're not trying to make you wealthy. They're trying to get you to read their stuff.
Or they are. It could go as far as they're promoting a specific thing for you to trade. Like there are articles. There are people. I mean, there's a lot of products out there. Endless amounts of products, and depending on what publication you're reading, a lot of these are sponsored by specific groups. American funds or what, like I'm not meaning to like call out anyone individual, just saying, giving examples of these different groups who are promoting and marketing just like any other product. And the more you trade, the better off they are. So just understand those incentives.
I think this is a great point too, just for TikTok advice as well, which, is rising now, or maybe less for our younger audience out there who is maybe more on TikTok than they are listening to CNBC. It's still like everyone trying to tell you a hot stock or do something. They really are just trying to get you to watch their TikTok so they can make more money, right? They're trying to become more popular, more of an influencer. So I find people are willing to say crazy things just to get people to click on their stuff because that's what makes them more money, right? They don't actually care about whether you trade the stock or not. They just want you to read their stuff. So I just think that's an important distinction to make there. I don't know. Do old people watch TikTok? Is TikTok a generational thing?
I mean, I think from what I have read, I mean, I'm not on TikTok. I'm not on any social, but from what I have read, TikTok has more hourly, like more use per hour, total hours of use, like during a day, more than I think it's like YouTube, Instagram, and Facebook combined.
That's wild.
Whoa.
I mean, that feels right. My friends, everyone I talk to, it's like, hey, when you're sitting on your phone relaxing, it's what are you watching? It's all TikTok video.
It's always TikTok. Here's the funny thing about TikTok that, the whole like story was it last year, or whatever, the Chinese spy balloon or multiple balloons, and
Yeah.
everyone was freaking out, right, of these Chinese spy balloons over the U.S. and on, kind of in the U.S. airspace, and people are losing their mind. Ironically, people were going on TikTok to lose their mind, and I'm like, do you not see the irony here that what you are complaining about, you are doing so on a device, a platform that is owned by the Chinese government, and they are openly stealing your data. Openly. It is not even a secret. It's just so funny to me that you're worried about a balloon when you are holding the platform in your pocket, that they're stealing everything from you. That's far more dangerous. So anyway, just kind of a funny side note. One other thing I want to come back to, Rabih, on yours. I'm gonna get in trouble for this one, but here we go. I'm a slow learner. I'm gonna say that. I'm gonna call myself out. But can someone help me understand the true use case for Bitcoin? Like, is there one?
I was going to ask about this. My question was going to be, are we about to do Bitcoin stuff again? It feels like all of our questions and things about that have died off over the past really like year and a half, 2 years. With this resurgence of, I think, other cryptocurrencies and with Bitcoin, is this happening again? Am I going to field
I don't know if it's going to
questions over the next week about crypto or no?
I don't know if it's going to be nearly as bad as what it was during COVID. That was a wild time with all the different, like, like you said, all the different coins that were coming out, all the different like NFTs and all that. I don't know if we're going back to that, but this is a genuine question. I'm genuinely trying to understand the use case for Bitcoin. Like, I guess I don't fully grasp the like what is the value there, other than I guess to be fair, to take the other side of this discussion, or the pushback someone might give me, is the entire market, the entire economy, this entire civilization is based off of the foundation of like belief. Like even like the dollar we have is just based on a shared belief in that actual paper. So it could go that far, but I'm just wondering, like, what is the actual use case? Truly, maybe it's just a rhetorical question.
No, Rabih, do you have an answer? What would you say?
I have so many answers.
He's like, how long do you want to go, baby?
I don't have a concrete opinion of it. I'll start with that. But it seems and feels like Bitcoin is not a new... Yes, blockchain as an algorithm is something that existed only in papers. Now it's being implemented. You have a ledger that is decentralized and is hard to manipulate, which is great. But we're talking about Bitcoin itself, not blockchain.
Yeah.
I think that's a huge distinction that I always like to tell people is we need to separate that out. Like, the technology of the blockchain is awesome, and we can do so many things with
and
that.
That's an obvious use case. Yes, blockchain's an obvious use case.
Besides the actual like Bitcoin itself and what its value is.
Yeah,
exactly. So talking about Bitcoin, I think we can all agree it's not a new invention or concept. It's a digital currency, just like our credit cards are digital currencies. The money in our credits is not actual dollars. It's just an account, a bunch of numbers on the bank's software. That's it. So digital currencies themselves are not a new concept. PayPal is one of them. Like, they aren't new. Our Mario Kart coins are digital currencies in that game. Like, it's not really something new. What is different about it is the fact that it is decentralized and the idea of decentralized. And here, allow me to go on a tangent for like 30 seconds, but the history nerd in me would tell you that part of why the Great Depression happened in the 1930s was because every single bank, before the creation of the Federal Reserve, had the power to print their own money. And because they had the power to print their own money, each bank, acting its own interest, controlled a certain portion of the money supply in the economy. And when you look at it as an aggregate, as a whole country, instead of like the personal interests of each entity, aka bank, the whole system failed on itself. Which the lesson that we learned, that monetary policy, the supply of money in an economy, should be centralized to be able to avoid a situation where, although individuals in the system are acting in their best interest, which is efficient and helps competition and is good, there will be certain times where, as a whole, capitalism would fail and the system would crash. That was the lesson we learned. And now we're saying we're bringing in a cryptocurrency, a digital currency, to take that power away and dilute it again, because we mistrust governments in the 21st century. Maybe draw the line. I've never been this vocal before on this podcast, but like maybe draw the line between the political motive for it and actually what we've learned from history about centralized money supply. If people are dissatisfied with how governments work in 21st century, regardless of the country, Bitcoin is a global phenomena. Why are you changing that by changing a system and an infrastructure that we had to learn the hard way?
Yeah, you know what's funny about that too is I get the decentralization point, but what's funny about the price of Bitcoin is it tracks almost lockstep with like the U.S. economy and the S&P 500. Like it's like there is no negative correlation there. It is not
the
like
idea of that's gone now, right? I
Yeah,
mean,
it
the
is not
idea of
like
negative
decentralized
correlation.
hedge.
Yeah, where that's
Yeah.
like, I think people do get into it where it's like, okay, I don't like kind of trust the stock market. I don't trust the U.S. government. This Bitcoin thing is going to be my hedge against all of those things. But it hasn't been a hedge. It literally just is lockstep with big tech stocks. It like performs exactly the same. And so that's always an interesting point.
Yeah.
That's fine.
I'm sorry to get down the rabbit hole. We can
We're
move
talking
on.
about
This could be
Bitcoin
a
now. I
whole
love
other
it.
show. This could be a whole other show for sure.
Not trying to get me fired up.
No. I just think it's interesting that you know, again, I always think this kind of stuff is interesting, and the narratives that are there, do they really match real life? So like, for example, on Bitcoin, the last thing I'll say on this is like how much of it is owned by billionaires right now, right? It's like basically billionaires own the entire currency. And, you know, they're the people that you would, you know, so I guess the question is the narrative there is it's decentralized, but is it really in real life? Like, is it just another thing, just another kind of form of what we've already seen?
Yeah,
Anyway,
I don't think people are investing in Bitcoin and be like, wow, there's a great use case for this down the road. I think everyone's like, oh, I want to make a quick buck here. I want to try and grow my wealth
most
more
people
than
are
the
probably
stock
doing
market.
that. They're treating it like a separate asset class. They're trying to make money on. You're right.
Exactly.
Okay, we can move on. Sorry to go down the rabbit hole, but I always think it's very intriguing. So, okay, next question. Is the market being lulled to sleep? This is kind of a separate Rabih topic that I hijacked, and I'm basically going to be like, hey, Rabih, what do you think? But I was reading an article this morning, and the title of it, markets are lulling themselves into a false sense of security. And what it goes, and here's the thing, we're going to try to be very careful with that, to not go super, super deep on this. This stuff gets really, really complicated, but good thing we've got Rabih here. So what the article goes on to say is that there are what's called structured products. And I'm going to let Rabih, I'm going to let you jump in here in a second to kind of give us a breakdown of this. But it talks about this product specifically called a structured product. And there's kind of different versions of this. Right. So, but it goes on to say how much money is going into these types of products. So just to give you some figures here, in 2020, the total kind of sales in these products was about 78 billion. As of 2023 alone, that number went up to 1 billion. And the most widespread of these products is called particularly big in Asia. I'm going to stop here for a second. Rabih, I'm going to let you jump in if you wouldn't mind and just maybe give us an explanation after you and I talk before going on here, kind of how this just generally works, these structured notes.
Okay. Structured notes are introduced as their own standalone product that is so different than a stock and a bond and like a derivative, like an option contract. They are marketed as their standalone thing where it tells you, oh, forget what the S&P 500 does. Forget what the interest rates do. This product is gonna give you 5% every single year for 5 years, 30%. The initial investment that you put in is gonna multiply by 2. Like, this is how they pitch it. It's like, look at this deal. However, we need to take a step back, and I'm gonna give you the analogy of colors. In colors, there are 3 basic colors: red, blue, and yellow. You can create every other color in, the ultraviolet electromagnetic spectrum that we can see from these 3. And structured products are the same thing. They are a combination of stocks, bonds, and derivatives on them to create this structure of a cash flow or the deal that you see. So when you strip it down away from the marketing, it's a way to literally structured note. Structure a note as a bond. Structure a bond in a sense that not only it gives you coupons, but it also gives you return related to the stock markets. You're combining return from the stock market with a cash flow regime that is related to bonds, and you're creating a structured note. They're complex products because once you mix these risks left and right, They do not disappear. They might cancel each other for a while, but under certain market conditions can blow up in your face. They are not for the retail investor. They should be addressed with a lot of caution.
Yeah, and I guess that's a question, right? Because you said they're not for the retail investor. Are these being so? But you also use the term, and I love this. You use the term. This is marketing, right? These are groups out there, and you said before you went on just how funny it is that the market creates these just out of thin air new products. So like this auto callable. Like who's ever heard of an auto callable before 2020? Nobody. Just like when you were saying in 2008, 2009, like the CDOs, right? All these different things that were literally created out of thin air and then sold. So I guess the question is, are these purchased by retail investors? Is it even possible by some of these groups, or is this more of an institutional type structure?
Well, I'm just going to say, I get emails bombarded by investment banks every single day. It's like, you can put your clients in those. Like if you're a client of dentist advisors can't put you in those products. Do we advise on them? Generally, no. But as Taylor says, general advice is not good advice. Maybe in some situation for a certain dentist, it might make sense. But that's a whole different tangent. And
this goes down a whole different thread of, again, this idea that you think like people think they equate complexity to good investment. It's like, oh, it must be a good investment because it's so complex. So they get lulled to sleep of like sophistication. And I'm now a rich dentist, so I should be in something more sophisticated. And these groups kind of prey on that, right? Jake, any thoughts on this before we move on a little bit on this?
I actually don't. I think you guys have hit on it.
Okay, so Rabih, this is the kind of the key point here that I wanted to get your take on. So what this article goes on to say is, so these particular structured notes, called auto callables, are very reliant on the market having a low volatility. And there's an index out there, maybe some of you have heard of it, but there's an index that indicates the volatility in the market. It's called the VIX. It's been around since the 80s, Rabih.
Early
and
90s,
so it's basically a volatility index. It kind of shows, again, the volatility that's out there. It's an indicator of that. And so as long as that is low, which right now, Rabih, where are we at roughly?
14. That's the level. Historical average is around 15, 16. In crashes, it shoots up to like 40s. COVID in 2008, where like it freaked out, it went all the way to the 80s. The lowest it's ever been is a 9. So you can imagine it just spikes up and goes down. It's like a heartbeat. It goes back down to its average, not like a stock where it has an upward trend.
Got it. So what these products rely on is low volatility, which Rabih, as you just pointed out, we are at very, very low levels. But what's interesting is it goes on to say, and this is where I want to get your take on this, Rabih, is it's kind of this chicken or the egg, or this like cycle that's feeding on itself, is what this analysis is claiming, is that because so much money is going into products like this that rely on low volatility, but a lot of these banks that are selling these notes are taking the other side of the client's bets, the other side of the trade. So it's almost like to hedge, right? To hedge their risk. So again, it's going on to say, is it kind of creating the actual low volatility environment that it needs? And what could that look like if that blows up? Not to scare anybody, but
that's a very rich question, multi-layered question. Okay, I think I'm going to touch on 3 points. The first point is we have to remember how those sellers of the structured products make their money. They are not taking the opposing end. They are just making commission on the transaction. So just like in 2008, when banks were selling mortgage-backed securities and CDOs and credit, they were hedging their other side, right? They sold it to the big short guys who made so much money. They were just facilitating the transaction to make commission. This is the same idea here. They do not know whether that note that they are offering is going to be a good investment or not. They don't care. All they want is to have the transaction pass through to take their commission. That's the first point. The second point, it relates to volatility. And when we're talking about volatility and implied volatility, the VIX over here, it's very important to notice we're not talking about historical volatility. We're not talking about the standard deviation of the stock price over the last 30 days. We're talking about expected fluctuations or expected standard deviation for the next 30 days in the stock market. So the stock itself doesn't really care whether we expect standard deviation next month will be 10% or 50%. A bond itself does not care. Those do not factor in how we price a stock or we price a bond. But for option contracts, for example, derivatives, they care about what expected volatility is going to be. They care about what the stock price is going to be at, what the interest rate is. So it's much more complicated, because while the stock price is determined by, I would say, 2 to 3 factors, aka the expected cash flow and the current level of risk in the market, and bonds care about the credit quality of the person taking on the loan and the general level of interest rates in the economy. Options by themselves depend on more than these factors, usually 5 to 6 factors. The options are derivatives based on underlying security. So the changes in that underlying security, volatility itself, the time until the contract expires, general level of interest rates, and the position, like the actual place where you enter that contract, called the strike price. So when you have 5 different variables moving at the same time, it just complicates stuff even more. And with the general example of a call option, for our listener who know a little bit about those, when you are going long a call option, you are actually taking on volatility risks. So if the VIX spikes up, the volatility goes up, the value of your call option goes up. On the other side, if you sell a call option, if volatility goes up, the price of your call option will go down. If the volatility goes up, yes, in a sense, the call option that you sold loses value. So you are against volatility. So what Matt is saying, those products do well when volatility is down, which means they are short volatility, which means if volatility does spike up, it's an abrupt shift into a new regime where suddenly all positions are at a loss, which is a tail event, which is a crash. So would it blow up? Hopefully not. Hopefully the banks who are making those transactions to make those commissions are offsetting the trade in a way that doesn't create this residual risk in the market. But generally, selling calls and being short volatility does not favor an investment long term. This is why a lot of even, day traders who keep on selling puts and selling calls blow up when large moves happen in the market.
Yeah, so a couple of things here, Rabih. That was great. Probably, I'm sure, deeper than we go normally on this show, but hopefully helpful. I think the key thing to take away from this is, at least as I'm listening to that, Rabih, is number one, you can make trading as complicated as you want, or investing as complicated as you want. There is endless amounts of ways that the market will continue to make this complicated, and they do it for a reason. They want to sell you crap. I think that's kind of the key here. The other thing I wanted to mention really quick, at the very end of this article, there's a quote from one of the market strategists from Bank of New York Mellon, what I thought was really interesting. He says, so he goes on to say that generally the VIX is not a great way to gauge potential trouble. And I think it's, Rabih, what you already highlighted, but he says low volatility begets low volatility until something goes wrong. And I think the key there is to what we've talked about many, many times, like the true risk is what you don't see coming. And so I just think that's kind of an interesting thing when you're trying to manage all these risks. It's like, you can't, this is why having a system, having a kind of a rules-based investing approach, having a long-term investment approach is so key, and not overcomplicating all of this. As Rabih just highlighted, this can get really, really complicated. So, Jake, any thoughts on that?
No, I agree with all you guys. Again, I really don't have thoughts.
Okay, awesome. Great. Rabih, any other thoughts? You want to finish that out before we jump to Jake's topic here?
Yeah, really quick. Sorry, Jake. I think this article is also influenced by recency bias. There's to give you a sneak peek of what's been happening in the trading community. 2022, the market went down by 22%, 20%, and the VIX never budged. And now everyone is thinking the VIX is dead. It doesn't indicate volatility. And a lot of articles are hypothesizing why it's happening. This is one of these articles where they're saying, because there are these new products that sell volatility isn't going up because you need someone to buy volatility. Do we know what really caused the VIX not to spike up? There are so many other theories that I've heard. Some of them are even more robust than this that might explain it. But this is just the market's way of trying to figure out and make money along the way.
Yeah, it's not a hard science on any of this, right? It's all just, like you said, theory and a lot of guesswork. So, okay, that's awesome. Jake, let's finish up with yours. Are you spending too much money? Yeah, you specifically, Jake, I want to know, are you spending too much money?
Probably.
I know I am.
This is a hard gear shift, right? So to segue here, none of the investment stuff matters if you're spending too much money. Your spending gets out of control.
Agreed.
So we've talked about in past 2 cents episodes how like consumer spending is kind of uplifting the economy, right? A lot of our economy health is doing great because people are traveling and spending, and we just keep buying and buying and buying, which is keeping businesses afloat and keeping people in jobs, which is great for the economy. But this can be bad on a personal level with their own spending. So where this is coming from is part of our job. We meet with a lot of dentists. I've been meeting with a lot of dentists at the beginning of the year. And one thing I like to go over is a budget or a cash flow and just see where things stand. And part of that, I want to look at just what is your overall spending. Rarely do I dive too deep into transactions unless it's necessary, but just want to see like, okay, what is your spending number? What are you spending over the past 6 months, over the past year? What does that look like? And guys, I think across the board, like I'm not talking 90% or 95%, like I think of dentist situations that I've reviewed, spending has increased. Like I can't think of a single instance where it's gone down from 2022 to 2020. And then I looked at my own budget and I'm like, I think that's true for me too. Like my spending has gone up pretty significantly over the past year or two. Does that feel, I don't know, Matt, you talking with dentists, does that feel right anecdotally?
Totally. I think it absolutely has. To what degree, I think it depends on the person, but yeah, I would totally agree. And I just maybe natural inflation that's been happening.
And so that's the point. That's the answer, I guess. We're talking this through, like, okay, spending's gone up. Why do we think that is? What are we attributing this increase to? And most everyone says, well, it's inflation. Groceries cost more. Just different things cost more. Like I don't feel like I'm living a more extravagant life. It's just been inflation. I think there's some data that would disprove that, actually. Where it's like, this is, people might hate me for this. Where it's not all just inflation. Okay, here's an example.
It's all behavioral. It's not inflation.
There we go. You know where I'm going to. So there's actually a tweet where this guy says he found a Burger King receipt from 1986. So that's almost 40 years ago now. Okay. And on this receipt.
Oh, don't say that. I was born in 86, dude. I was born in 86.
That's a really short time ago. Yeah, that's not even that long ago.
Gosh dang it.
Okay, this guy bought 3 Whoppers, 2 fries, and 2 large ice creams. And it cost $8 for all of that stuff. And so this guy tweeted this out and was like, can you imagine, like, oh my gosh, America was so great. You could buy all this stuff for $8, 40 years ago.
How much is it now? Like 25, 30?
So then someone says, okay, now you can buy that exact same meal. It would cost $27 for that same meal now. And so that seems like a huge, crazy jump. But some smart, data-informed person actually responded to this tweet and said, back in 1986, the average hourly wage was $7. So that meal that was $8 actually cost a little more than 1 hour's worth of work back in 18. If you fast forward to today, the average hourly wage is almost $30 actually today. And so that meal today actually costs less, and adjusting for salary increase, than it did in 19. So like our salaries, like, yes, things have gotten crazy inflation over the past couple of months and over the past couple of years, but our salaries have actually kept up pretty well. Like income in America has really grown. And so there's actually different statistics of housing and tuition and cars are actually pretty much in lockstep with what they were 40 years ago compared to what they are now, like adjusting for our incomes.
Yeah, we passed this data around internally, right? I don't have it in front of me, but we passed some things we found online of some people posting stuff to this very point, Jake, where the data does prove, and it's just data. Data is neutral. Like, it's just data. It does prove that it's not as bad as the narrative is making it seem.
Yeah.
The data actually is showing that it's actually about the same as it was 40 years ago, 50 years ago. But I'm going to lead the witness here, Jake. What has changed?
Yeah, so what I think this is great is I think our expectations have changed of what we think an average lifestyle should be.
Yes.
Right? Everyone always talks about, like, oh my gosh, in the 1950s, you could have one income and send your kids to school and buy a house and different things there. But what they didn't have in the 1950s were all the different iPhones and laptops and things they didn't have to buy. They didn't have, like a walk-in closet and a 6-burner stove that they were expecting as part of a normal lifestyle. They weren't going on 3 different vacations to Europe every single year as part of an average lifestyle. They weren't all of these different expenses that we kind of now consider normal part of life. Like, we should be able to buy a house and to go on 3 vacations and to have the newest smartphones and to have all the best clothing. We think that's should be the average of the norm. And I just think there's so many more expenses we have in our daily life that people just didn't even think about or deal with 40 or 50 years ago. And so I just think our expectations have grown so much. And so when I'm going through these budgets with different clients, a lot of times, like, okay, like, what's your daycare expenses? What's your mortgage? What are all the necessary fixed stuff? And a lot of times that's accounting for half of their budget, which is actually pretty healthy. And then the other half is all just leisure expenses and luxury items, which again, I want to like be clear. I am not against like don't spend money. Like your money is going to be spent at some point. But I just think we are getting so used to spending and consuming that it can actually hurt our finances at some point. And it's not all the blame just on inflation and your groceries costing more. I don't know. Does that
Yeah,
make sense to you guys?
totally. Like you said, Jake, I don't think we're saying don't spend. We
No.
are saying spend intentionally, enjoy your money. You definitely should. I think what we're saying and what you're getting at and we've talked a lot about is, again, the narrative does not match necessarily the reality. That is the yearning for the good old days of what it used to be like. Like that whole thing is just it's kind of this, again, marketing narrative, this narrative that is not backed up by data. To your point, like just to give a specific example of where expectations have outpaced actual growth of income is like you said, vacations. It used to be camping was a worthy vacation for a family.
Yeah.
Now it's like if you're not going on 2 or 3 trips, Hawaii and Europe or whatever, that's not a quote unquote normal life. There's a lot of reasons why this is social media, whatever it may be, just the natural growth of an economy, people. So totally
And that's
get
a
it.
big deal, right? So vacations, which I am a big proponent of going on vacations. I love to. I have a few trips planned for this year. Again, not saying don't go on vacations, but if we're looking at a budget, vacations now, again, airline tickets are expensive, hotels are expensive because everyone's going on these trips. And so costs just keep on going up. But if you do if you're a family of 4 or 5 and you go on 2 big trips a year, that's probably costing 20 grand to go on those 2 trips or something. That's adding
Or more.
$2,000. Yeah, that's $2,000 a month to your budget just by
Yep.
those trips they are going on, which is a big thing to do in there. And so here's my last point. We can kind of move on from this, but spending is just so important when you're trying to figure out how much do I need to retire and kind of looking forward to that. It is a huge indicator of what you need. Because so increasing your spending actually negatively impacts your finances twofold. One, the more you spend, the less you have to save, right? There's just the less left over to save and invest. But it also increases the amount you need to save or you need for your nest egg, right? So it impacts your finances twofold. For example, we always talk about to getting to retirement, you probably want about 25 to 30 years of your annual spending built up as like a really good back of the napkin rule of thumb, if you want to use that. And so if you spend $100,000 a year, that means you'd probably want around $3 million in assets, right? By the time you want to hang things up. If you just say, hey, we increase our income by 50 grand a year, which isn't crazy. A lot of people do that over the course of their life. That's increasing the amount you need from $3 million to $4.5 million, right? That $50,000 increase increases what you actually need by $1 million plus dollars. So again, I'm not saying don't spend money, don't go on trips. I'm not saying that. I'm just saying, I think it's important. I just always want to check in. Like, let's just be conscious about what we're spending and making sure it's in check because it really is a big deal when kind of talking about
Just being
how much
aware
you
of
need to
it.
retire.
Yeah. Rabih, final thoughts on this at all?
Yeah, not only being aware of it, I have to admit, you guys, it's so hard. Like even if you're aware of it, because I'm taking my example, which is a little bit extreme. I moved from Lebanon, which if you just compare the GDPs of Lebanon compared to the US, there's a huge socioeconomic jump upwards, right, for me. And it didn't take me long to start spending like Americans with the same expectations. So it's so hard. So I don't think being aware of it is enough. You need someone to bring you back down to reality. You need an accountability check just to make it. I'm here pitching the role of
No,
advisors.
that's a great point.
For
No,
me, it's
yeah.
also like my friends in Lebanon is like, what happened to you? Why do you spend that much money without thinking of it? But
I think
for
that's the
people in
point,
the
Rabih,
US,
is because we're not like it's all growing kind of without us thinking about it, right? Where that's I think the point I want to make is let's think about this on occasion, like once or twice a year. Let's take a health check on your spending because in my own life, I'm just like, we just get so caught up in kind of this consumerism and different lifestyle that our spending just creeps up without us even noticing.
Well, and again, what used to be luxuries has now been normalized to normal life, right? A European trip used to be a luxury reserved for the rich. Now it's like for everyone.
Or just the 15 different things I need for my kids, apparently, like all the
it's
different.
Never been easier to spend money on stuff. Yeah, you just drive around, you get online, like you look about, how easy it is to spend money. It was 50 years ago, right? That alone, to Robbie's point, makes it really difficult. American consumerism is alive and well for sure.
Yep.
So that's great, Jake. I love that. Like you said, a hard gear shift. We covered a lot today, guys. It was a heavy episode. Hopefully, it was helpful. Still trying to find a balance of how deep to go on some of this stuff, but again, we really enjoy it. Hopefully, you guys do too. Jake, Rabih, any other final thoughts on any of this? No. Okay. Thank you guys for being here. We want to plug again We're going to keep doing this till it happens. Dennis Money Summit coming up June 21st and June 22nd. We've been saying the 20th through the 22nd. We kind of realized it's actually the 21st and 22nd is the actual event. So check-in is the 20th, obviously, but the actual event is June 21st and 22nd in Park City, Utah. It is going to be incredible. We just released the Daniel Crosby episode, one of our main speakers. We have other other interviews coming up with our main stage speakers over the next coming weeks and months. It is going to be an incredible event. I'm getting so excited that it's actually just around the corner. Check it out, Dennis. Again, Rabih, Jake, thanks for being here. Everyone, thank you for listening. That's our 2 cents. You guys all know what is left. There's only one thing left to do. That is to go forth, live your rich life. Till next time, bye-bye.